Shri Gurubhyo Namaha. Salutations to all my gurus, without whose help and guidance I wouldn't be what I am today or where I am today. Good evening, everybody. Let me at the outset thank the ICA Corporate Laws and Corporate Governance Committee and the Tirupur branch of SIRC of ICA for inviting me to be a part of this refresher course on corporate law. And I'm extremely thankful to both the chairman and the secretary of the branch for introducing me. And they were kind enough to say I've been a part of the branch. I sincerely thank you for that. Tirupur is not new to me, as both of them mentioned. I think I have, in fact, I think I've spoken there very many times on bank audit, and sometimes on other topics also. Maybe this is the first time I'm talking to the Tirupur branch on a topic like corporate law. In fact, to be very honest, I did my articles way back in late 70s and early 80s of the previous century, when what we had was Companies Act 1956. And I used to read Companies Act 1956, the treatise written by Advocate Ramesh. That was the Bible for me. When Companies Act 2013 came into existence, I had already finished. I was already 55 years old, and I said, well, do I really need to read a new act? Can I not survive without reading this act and referring to it only if and when I needed to? Because basically it was the same. There were a lot of changes, but basically the corporate law is the same. And therefore, I did not spend too much time reading Companies Act 2013. But then in the last 3 months or so, I think I've read more on Companies Act 2013 than in the last 7 years, for the simple reason that the Corporate Law and Corporate Governance Committee of ICA requested me to speak on the subject, and the Chengalpet branch was the first branch to call me and asked me to address on this particular subject. I must admit that the Companies Act is very difficult. It is not like the 1956 Act. It has several circulars, notifications, rules, unlike the 1956 Act. This Companies Act is more notification-oriented and rule-oriented, which was not so in the previous Act. And to that extent, I think we need to keep ourselves updated with the day-to-day happenings by reading the various circulars, rules, and notifications issued by the MCA. It's been a very pleasant task to prepare on this particular subject. And without wasting further time, let us get into the subject proper. The topic that was given to me is special aspects for private limited companies and OPCs. I interpret the heading as what are the special exemptions available to private limited companies and one-person company. So with that in mind, I have prepared this presentation. Just one second, it doesn't seem to be moving. Before I launch into the subject matter, let me tell you that I'm not dealing with the exemptions which have already been granted to small companies or OPCs by the Act. I am only going to refer to those exemptions which have been given to private limited companies and OPC by notifications. Because what is there in the Act already is there in the Act. When we read the section, if it does not apply to a private limited company, it is very clearly stated in the section that notwithstanding anything contained in the above process, this section shall not apply to a private limited company. So I am not going into those kind of exemptions. I'm only going to those exemptions which have been granted by two circulars which are issued in 2015 and 2017. There are 22 exemptions that was granted in all. There was also a condition. After all these exemptions are given, there have also been a condition, which is not fulfilled, the exemption is not available to private company. We look at that condition at the back end of my presentation. There has also been an advisory in these notifications, which is more to protect the interests of the various stakeholders, which is there in the notification, which again we'll draw reference to at the back end of my presentation. What I intend doing in this session is looking at the notification which grants these exemptions. We will look at certain definitions. We will look at definition of a small company. We'll look at definition of a small and medium company and some other definitions. Then we'll go into what are the exemptions that are available, chapter-wise exemptions listing. We will do a detailed analysis of all the exemptions, and finally we will conclude with the conditions and advisory that is a part of the notification so that we are aware that in certain cases, these exemptions may not be applicable to a particular private limited company because they have not fulfilled a condition which has been stated in the notification. Two notifications are issued, as I told you, one on 5th June 2015, and the second one was issued on 13th of June 2017. The first notification is referred to as the principal notification. Why is it referred to as the principal notification? It's very, very simple. If you look at the notification issued on 13th June 2017, they are actually renumbering a clause in 2015 or inserting a clause after a particular clause in the previous notification. In fact, the 13th June 2017 notification refers to the notification of 15th June 2015 as the principal notification. So all your exemptions for private limited companies stem from a principal notification and a subsequent notification, which has actually amended the principal notification by inserting certain clauses in addition to what are already available in the 2015 notification. Now, these notifications, the two notifications, applies to private limited companies as defined in section 2, subsection 68 of the Companies Act 2013. Now, what does section 2, subsection 68 of the Companies Act actually talk about? We are all aware of what are private limited companies, but I would still like to read that particular section. Private company means a company having a minimum paid up share capital as may be prescribed and which by its articles restricts the right to transfer its shares except in case of one-person company limits the number of its members to 200. Essentially, a private limited company should restrict the right to transfer its shares and it cannot have members of more than 200. This is what has been defined in section 2, subsection 68 of the Companies Act. And all these exemptions are available only to that private limited company. Why I'm emphasizing on that is, you could have a private limited company which is a subsidiary of a public company. Or, I'm sorry, it could be a subsidiary of a public company for which these exemptions are not available. Because 71, section 2, subsection 71 of the Companies Act defines a public company means a company which is not a private company and has a minimum paid share capital as we prescribed, provided that a company which is a subsidiary of a company, not being a private company, shall be deemed to be a public company for the purpose of this act, even where such subsidiary company continues to be a private company by its articles. So if there is a private limited company which is a subsidiary of a public limited company, it is deemed to be a public limited company, and therefore the exemptions granted with these two circulars in 2015 and 2017 are not applicable. The exemptions are available only to a private company as defined under section 2, subsection 68 of the Companies Act 2013. Now let's look at, let's spend a little time looking at the definition of a small and medium company. A small and medium company is one where the shares are not listed, are not in the process of listing on any stock exchange in India or outside India. It is not a bank, financial institution, or an insurance company. Its turnover, excluding other income, does not exceed 250 crores in the previous accounting year. Borrowings, including deposits, does not exceed 50 crores at any time during the year, and which is not a holding or a subsidiary company of a company that is not an SMC. So, a small and medium company definition has been given not by the Act, but by the accounting standard rules. Why am I looking at this? After all, I'm only talking about exemptions of private limited companies. So, why am I going to the accounting standard rules? Accounting standard rules is defined small and medium company. And this accounting standard rules itself came into existence in 2006 and was amended from time to time. On June 23, 2021, in consultation NAFRA, MCA issued Companies Accounting Standard Rules 2021. These accounting standards shall come into effect in respect of accounting periods commencing on or after the first day of April 2021, which means for the purpose of the balance sheet that we are now going to attest for year end at 31 March 2022, Accounting Standard Rules 2021 will apply. Excuse me. Again, coming back to why I want to bring this is the definition of a small and medium-sized company in the Accounting Standard Rules is different from the definition of a small company in the Companies Act 2013. We need to be aware of this. We should not be carried away by the definition of either one of them and apply to the other. The small and medium-sized company has been defined in a particular way in the accounting standard rules, and it only says that these small and medium companies are exempt from certain compliance with certain accounting standards, both with reference to disclosure and as well as measurement. So, SMC definition is valid only for the purpose of exemption from accounting standards, both measurement and disclosure. And that definition cannot be applied to exemptions for a private limited company. For exemption for a private limited company, we need to go by the Companies Act definition. And Companies Act is defined a small company as one where the paid-up capital is less than 2 crores and the turnover is less than 20 crores as per the profit loss account of the immediately preceding financial year. In other words, if as on 31st of March 2022, you are auditing a private limited company, you need to look at the paid-up capital of the company. If the paid-up capital of the company is less than 2 crores, and if the turnover of the company for the year at 31st March 2021 is less than 20 crores, it will be a small company, and all the exemptions available under these two notifications will apply to that company. The exclusions are: it cannot be a holding or a subsidiary company, it cannot be a Section 8 company, and it cannot be a company or a body corporate governed by any special act. Now going into CARO, I would also spend a little time, although that's not part of the subject matter that we're discussing today. I'm sorry, my throat is very badly hurt, and so I keep sipping something hot. CARO, as defined, CARO is the applicability of CARO. It says it shall not apply to a small company. So if by looking at the definition of a small company, you conclude it is a small company, CARO is not applicable. We will again deal with this at the later part of my presentation, but please remember that CARO need not be given if the company is a small company. There are lots of private companies that I audit where the paid-up capital is less than 2 crores and the turnover less than 20 crores, and I do not give a CARO. I mean, the limits are different last year, but for this year it is 2 crores and 20 crores, and I will not give. But I will have in the main audit report a statement to the fact that it is a small company, and therefore I am not reporting under CARO. You can have that. Do not give CARO. I, for one, always believe that never give more report than what is required. If law asks you to give a report, if the law requires you to give you a report, and if there is an exemption available to a particular corporate that you're auditing, please avail that exemption and do not give the report and state something there which will actually put you into trouble. So if CARO is not applicable, let's take it as CARO is not applicable and not give that instead of giving CARO blindly. In chapter 1, in 2 sections, in fact, in 1 section and 2 subsections, there have been changes, which is the definition of a related party.
Amendment on the board, impact credit ledger adjust.
Then there is a chapter 4, which deals with share capital and debentures. There are some exemptions given to private limited companies from the application of those chapters. Then chapter 5, which deals with acceptance of deposit by companies, a very important chapter where a violation of any of those in accepting deposit by private company can result in very serious consequences for the private limited company, and therefore chapter 5 dealing with acceptance of deposits by companies is a very important chapter for all of us to read, and we will spend a little time on the exemptions available to a private limited company which accepts deposits from the public. We will also look at chapter 10 or rather chapter 7, which deals with management and administration. There are 8 sections in this particular chapter where exemptions have been granted to private limited companies. We will understand what those exemptions are and what can be provided in the articles of authority of the company to ensure that we need not comply with these 8 sections that is listed there, 101 to 107 and 109. Moving on to chapter 11, or rather chapter 10, audit and auditors, we will talk about what are the exemptions available there. We will also spend a little time on understanding whether the rotation of auditors can also apply to a private limited company. And then we will look at appointment and qualification of directors, move on to meetings of board and directors, and finally we will look at the exemptions available in remunerating a managing director or a whole-time director, which is contained in chapter 13, appointment of a MD, whole-time director and manager. Are there anything that is of relevance to a private limited company in section 186.4 and 186.5, or is it not there, is what we will go to see. Section 2, subsection 40 has defined the components of a financial statement, and it includes a cash flow statement for the financial year. But the proviso of the section states that OPC, small company and dormant company, and a private company, if such private company is a startup, cash flow will not apply. This is what was there in the Act. So essentially, for a private company, which is a startup company, cash flow is not applicable, was what was there in the original Act. And who decides what a startup company is? Again, I think we need to spend a little time understanding how a startup company is defined. Explanation to section 2, subsection 40, proviso states, for the purpose of this Act, the term startup or startup company means a private company incorporated into the Companies Act 2013 and recognized as a startup in accordance with the notification issued by the Department of Industrial Policy and Promotion, Ministry of Commerce and Industry. So if your client says he's a startup, today the word startup is grossly misunderstood in the company. People the youngsters today start a company and say it's a startup. To be a startup company, it should be recognized as a startup in accordance with the notification issued by the Department of Industrial Policy and Promotion, Ministry of Commerce and Industry. And unless that recognition certificate is available, do not accept the company as a startup, even if in your opinion, after reading the notification, you are sure it is a startup. Recognize it as a startup only if there is a note, if the Department of Industrial Policy and Promotion has recognized it as a startup and has given a unique identification number for that corporate that you are auditing. What did this exemption say? Now, the exemption says private companies which are not small companies or startups are not exempted, was what it was there, right? Now it says, the notification, 2015 notification says, provided to the financial statement with respect to one-person company, small company, and dormant company may not include a cash flow statement. So which means startup, the word in the brackets that you see there, if such private company is a startup, has been taken away. So every small company, every private company which is a small company, cash flow statement is not a must. I have seen during the course of my bank audit when I was looking at various credit proposals, I have seen several small companies giving the cash flow with tremendous amount of mistakes. Why give something which is not required, and especially when there are several mistakes there which actually can turn against us. So please check whether the company is a small company as per the definition given in the Companies Act, and if so, cash flow statement will not be applicable to it. Section 2, subsection 76 says, a related party with reference to a company means any company which is a holding, a subsidiary or an associate company of such company, or a subsidiary of a holding company to which it is also a subsidiary. The exemption notification says, section 2, subsection 76, clause 7 shall not apply to a private company with respect to section 188. What does this mean? Does it mean that the entire section is not applicable to a private limited company? That the entire section 188 is not applicable to a private company? I am afraid that will be a wrong interpretation. Let us look at section 188 and then come to a conclusion that the entire section is not applicable or a portion of that particular section is not applicable. Section 188 says, except with the consent of the board of directors given by a resolution at a meeting of the board and subject to such conditions as may be prescribed, no company shall enter into any contract or arrangement with a related party with respect to sale, purchase or supply of any goods or materials. 2, selling or otherwise disposing of or buying property of any kind. 3, leasing of property of any kind. 4, availing of rendering of any services. 5, appointment of any agent for the purchase of sale of goods, materials, service or property. 6, such related parties appointment to any office or place of profit of the company, its subsidiary company or associate company. And 7, underwriting the subscription of any securities or derivative thereof of the company. So if these 7 activities have to be performed, the board cannot do this can only do this by resolution subject to certain conditions prescribed in this. No company can do it without the consent of the board of directors. This is what section 188 subsection 1 states. There is a proviso to the section which says, provided that no contract or arrangement in the case of a company having a paid up capital of not less than such amount as may be prescribed, or transactions exceeding such sums as may be prescribed, shall be entered into except with the prior order of the company by a resolution. So essentially, 188 says that 7 activities can be done by the board only with the consent of the board of directors, and even they will have to get the approval of the company in general meeting if the share capital is paid up share capital is beyond a certain specified limit, or the transaction is beyond a particular specified. So when the notification says 276(7) shall not apply to a private company, what does it actually mean? The second provision to the subsection says, provided further that no member of the company shall vote on such resolution to approve any contract or arrangement which may be entered into with the company if such member is a related party. Only that proviso exemption is available to private limited company. Private limited company also, if it wants to, let us say, lease out any of its property, will have to have a board resolution passed. But the only thing is the interested party or the related party can also vote. They need not abstain from voting. That is the exemption given to a private limited company by the definition, by the by the exemption which says 276(7) related party. This is what is there. First provision mandates prior approval. Second provision says that no member of the company shall vote on such resolution to approve any agreement if such member is a related party. Second provision is not applicable to a private limited company. So it is not as if the entire section is exempt. I can lease out a land, a private limited company can lease out a land without getting the board approval. No, that is not the intention of the legislature. The legislature is very clear. It only says that the related party can vote, and that is the exemption given to a private limited company. Screen seems to be stuck. Yeah. Let us look at section 43. 43 talks about share capital of a company limited by shares shall be of 2 kinds. 1, an equity share capital with voting rights or with differential rights as to dividend, voting or otherwise in accordance with such rules as may be prescribed, and B, preference share capital. Section 47 deals with voting rights. Voting rights, what section 47 says is subject to the provisions of section 43, subsection 2 of section 50 and subsection 1 of section 188, every member of a company limited by shares and holding equity share capital then shall have a right to vote on every resolution placed before the company, and his voting right on a poll shall be in proportion to his share in the paid up equity capital of the company. So essentially what it says, talks about, these 2 sections talks about is 43 talks about the kinds of share capitals. 1, equity differential rights and preference shares. The exemption says section 43 shall not apply to private company. Does it mean that a private limited company can issue any kind of share capital? I don't think so. Again, can a private limited company only have preference shares? Without any equity, can have only preference shares? In my opinion, no. In fact, I was talking to a very senior company secretary who was also the deputy registrar of companies, deputy registrar of the MCA, Ministry of Corporate Law, before she quit and started her own practice. And she says there is, in practice, no company will be allowed to be incorporated with just preference share capital. There must be equity capital. And therefore, our interpretation of the exemption notification says this section 43 shall not apply to a private company. All it means is it can have an equity capital, one portion a normal equity capital, and another portion with reduced voting rights and reduced dividend. Yes, that is possible for private. That is not possible. That is possible for a private limited company. Voting rights again. The Act says the voting rights shall be in proportion to the share in the paid up equity capital. Private limited company, it need not be proportionate. They can state so in the article of association. So, which means it is not as if these two sections will not apply to private company. Certain specific exemptions have been given, and these exemptions are to be read in the correct context in which the legislature meant it, and not as if I can issue any kind of share capital. I don't need to issue equity capital at all. I can issue preference share capital. That would be a wrong interpretation. You can issue equity capital. You can have one set of the normal equity capital and one set with differential rights in voting and differential rights in dividend. All those things can be stated in a private limited company. When it comes to voting, you can say it need not be in proportion. The promoters will have so much voting rights. The non-promoters, the other shareholders will have only so much voting rights. All this can be stated in the articles of association or memorandum of association. And at that point of time, when we frame those two documents, we need to be careful as to what the client wants and put them in so that he actually enjoys the exemptions granted by these two notifications. Moving on to section 62, which talks about further issue of share capital. The notification reads as follows. Chapter 4, subclause 1 of clause A of subsection 1 and subsection 2 of section 62 shall apply with the following modifications. In clause A, in subclause 1, the following provisions shall be inserted, namely, provided that nothing contained in the subclause and subsection 2 of the section, in case 90% of the members of a private company have given their consent in writing or in electronic mode, the period lesser than those specified in subclause or subsection shall apply. Now, let us look at what section 62 actually talks about. Section 62 says that any further issue of share capital, the time period for offer of rights issue shall not be less than 15 days and not more than 30 days from the date of which the offer is made. And if it is not accepted, shall be deemed to have been declined. Section 62(2) talks about dispatch of a notice at least 3 days before the opening of the issue. The principal notification states that in case 90% of the members of a private company have given their consent in writing or in electronic mode, the period lesser than those specified in the said subclause or subsection shall apply. All this is for a normal company. For a private company, need not wait for minimum 15 days, but can close its offer of rights issue in less than 15 days. That is possible by this exemption. The period can be reduced to less than 15 days, but it cannot be extended beyond 30 days. So a private limited company which is coming out of the rights offer can, minimum period it has to give can even be 1 day. It need not be 15 days. But it can't say 45 days. It has to be less than 30 days. The notice, the rights offer, the private limited company, the notice for making the rights offer may be dispatched in less than 3 days before the opening. It need not be 3 days before the opening, it can be 1 day before the opening. That also is possible. A private company can now close its rights share on the same day. So as I said a few minutes before, it can open and close it on the same day, unlike other companies which has to wait for 15 days before they can close. That is what this actually says. What about ESOPs? A special resolution is required for an ESOP. That is applicable. Is that applicable to a private limited company? We look at that. Section 62(1)(b) provides the rights offer shall be made to employees in the scheme of employee stock option by passing a special resolution. That is applicable to a private limited company also. I don't think there is an exemption. I'm sorry. In case of a private limited company, the requirement of passing a special resolution has been done away with, and a simple resolution is sufficient. So again, it is not as if the entire section is exempted, but specific some very relevant exemptions have been given for private. They can close the offer before 15 days. They don't have to pass a special resolution ESOP. They can dispatch the notice just 1 day notice. A 3-day notice is not required, and so on and so forth. The next section we will consider is section 67, and this is one exemption which I am not able to understand. We will read the section and then look at the primary notification as to what it actually means. Section 67 talks about restriction on purchase of company. Restriction on purchase by company or giving of loans by it for purchase of shares. So can a company purchase its own shares? One. And two, can it give loans for purchasing shares? These two matters have been dealt with in section 67. Section 67(1) says, no company limited by shares or by guarantee and having a share capital shall have power to buy its own shares unless the consequent reduction of share capital is effected under the provisions of this Act. What does it actually mean? No company limited by shares or by guarantee and having a share capital shall have the power to buy its own shares unless it leads to a reduction of share capital. In other words, a company can buy its own shares. The buyback of shares, which has been dealt with by section 68 of the Act, the very next section deals with it. Section 67 says you cannot buy the shares unless it leads to a reduction in share capital. Which means I cannot buy my own shares and keep it as investment in the assets. That is not possible. It is allowed in some countries in the world, but in India it is not allowed. So when the exemption says, the exemption notification says section 67 will not apply to a private company, what does it mean? Does it have any meaning at all? Anybody who has anything to say on this? Before going into answering the question, let us also look at subsection 2 of section 67. Subsection 2 of section 67 says, no public company shall give, whether directly or indirectly, and whether by means of a loan or guarantee, the provision of security or otherwise, any financial assistance for the purpose of or in connection with the purchase or subscription to be made by any person or for any shares in the company or its holding. So a public limited company is prohibited from giving loan to anybody to buy its own shares. That is not applicable. 67(2) is not applicable. 67(1) will continue to be applicable to everyone. The exemption granted by serial number 5 of the principal notification is only for section 67(2) and not 67(1). So a private limited company can give loans to anybody to buy its own shares. The only thing that you need to be careful here is whether section 2, subsection 22, clause E of the Income Tax Act will apply, where this loan should not be considered as a deemed dividend if it is given to its own shareholders or the directors to buy further shares. Because 222E will definitely classify this as a deemed dividend, provided the company has reserves and surplus, huge amount of reserves and surplus, and it is lending money because they are not non-compliant with Companies Act. They are in compliance with Companies Act. They are lending money to its own shareholders to buy shares in the company. Section 2, subsection 22, clause C of the Income Tax Act will be attracted, and we need to be careful about that. Acceptance of deposits. Chapter 5, clause A to E of subsection 2 of section 73 shall not apply to a private company is what the principal notification states. I'll read that again. Principal notification states, Chapter 5, clauses A to E of subsection 2 of section 73 shall not apply to a private company. What are the clauses A to E of section 73(2)? In order to accept deposits to the public, there must be an issuance of a circular to its own, not from public, from its own members. There should be an issue of surplus to members. There must be a filing of a copy of circular with ROC in 30 days. Deposit of 15% in separate bank account. Providing deposit insurance to the fourth point, which has now been omitted by the Companies Amendment Act. And D, certifying the company has not committed any default in repayment of interest or deposits. In order to get exemption from these things, certain conditions have been prescribed. A private limited company need not comply with all this, provided it fulfills certain conditions. That is what has been stated in the principal notification. Now let us look at what those conditions are. Before going to that, this acceptance of rule says clause 8E shall not operate a private company which accepts from its members money not exceeding 100% of the aggregate of the paid up share capital, free zone security premium, which is a startup for 5 years from the date of its incorporation and which will fulfill the following conditions. It is not a subsidiary, associate or a subsidiary. The borrowings of the company for banks should not be more than 50 crores. Company has not defaulted in the repayment of any borrowings subsisting at a time of. If these conditions are satisfied, then you don't have to comply with clause A, B, and clause A, B, C, and D of section 73(2). In other words, you don't have to issue a circular to your members. You don't have to file a copy of the circular to the ROC in 30 days, and you don't have to certify that the company has not committed any default. But if you look at that, if you look at the condition, it says the company should have repaid all its deposits, and therefore that also really does not make any sense here. Only the issuance of the circular and filing a copy of the circular with the ROC in 30 days is not applicable to private limited company which accepts deposits subject to fulfillment of certain conditions. I would want to deviate a little bit from the given topic on hand and look at the definition of deposit in the acceptance of deposit rules 2014. 2014 says deposits include any receipts of money but does not include, and I would like to read clause 7, any amount received from a person who at the time of receipt of the amount was a director of the company or a relative of the director of the private company. Invariably, I think most private limited companies' balance sheet will have loan from directors because that is the only deposit exempted which they can take. Other than accepting deposit from its members, the only person whom they can accept it is from a director or relative of a director. And to that extent, both the company and the auditors feel it's a safe way to do it, and they show it as loan from directors. But then the proviso to that clause 2C7 says that the director at the time of giving the loan to the company must furnish a declaration in writing to the company to the effect that the amount is not being given out of funds borrowed by him. Now, I am the auditor of a private limited company. I am also filing the tax returns for the director. I know very well from while preparing his individual tax returns that he has borrowed money and lent money to the company. What is my role as an auditor? I know that he has given a false declaration to the company when he gave the loan to the company and said, treated as loan from directors. As an auditor, when I sign the balance sheet of the company, am I not actually signing something which is wrong because I have knowledge of it? Can I be hauled up tomorrow for not doing my duty properly? Something which we need to consider. I'm not expanding on the particular subject. I would just like to bring this to the attention of members for a deliberation at a later date or deliberation amongst a smaller group in the branch to ensure that we do not get caught between these two contradictions that I spoke about. I am the auditor, and if I'm the auditor of the corporate alone, there is a declaration in writing, I don't have to go beyond. I am the auditor of the company. I'm also filing the return of the director, where I know that he has borrowed money and has lent to this company. Is there a conflict of interest? Will this conflict of interest have any impact on my signing of the corporate balance sheet? Something to ponder about. Please do ponder about it. Have more detailed discussions on it, then come to conclusion. Pretty simple exemption. 92(1)G states that the disclosure of remuneration of directors and KMP in the annual return. However, in the case of a small company, it is sufficient to disclose the aggregate amount drawn by. You don't have to split them into director A, director B, director C. You can aggregate all of them together and put it there. It's an exemption. I don't really know what kind of great exemption is it, but it is an exemption that is given. Section 92 says the annual return must be signed by a director and the company secretary, or where there is no company secretary, by a company secretary in practice. The first proviso says, provided in relation to a one-person company or a small company, the same shall be signed by a company secretary, or where there is no company secretary, by a director of the company. The notification is only substituted the provision. It says, in the case of one-person company, small company, and private company, if such private company is a startup, the annual return should be signed by the secretary or whether it's no company secretary by a director. In other words, only startups are also now exempted from this. Otherwise, not all private companies are exempted. Only startup private companies are exempt. Although simple, there are slip-ups that can happen. This is a very simple exemption, but let us remember that it is not applicable to all private companies. It is applicable only to a private company, which is a startup. Again, I am not really sure whether this exemption has a great meaning or whether it really benefits anybody, but it has been given as an exemption by the notification, and I did not want to miss it out. Moving on to management and administration. Now, this is where about 8 sections exemptions have been given to private companies. The chapter which contains the maximum of exemptions by the exemption notification of 2015 and 17, this is what has been given. Section 101 deals with notice of general meeting. 102 talks about statement to be annexed to a notice. 103 talks about quorum. 104 talks about chairman of a meeting. 105 proxy. 106 is restriction of voting rights. 107 is voting by show of hands. And 109 is the demand for poll by the shareholder of the company. All the above sections shall apply. Isn't it a little confusing? I'm saying shall apply. Although the topic is exemptions. Shall apply otherwise, unless otherwise specified in the respective sections or the articles of the company provide otherwise. The clue is in the articles of the company provides otherwise. So if your article says something else, which is within the confines of law, then articles will apply and not what is stated in the Act. For example, notice of general meeting, a 21 days notice is required by the Act. In a private limited company, can say only 1 day notice will be required. That is sufficient. Because the articles clearly states only a 1 day notice or a 3 day notice or a 5 day notice is sufficient, then that is what will happen. Nobody can find fault with you for not giving a 21 day notice. Under 102, a statement is to be annexed. A statement setting out the following material facts covering each item of special business to be transacted at general meeting shall be annexed to the notice calling for the meeting, such as the nature of concern or interest or financial or otherwise, if any, in respect of each item of every director and manager, every KMP and relatives of directors and KMP, and any other information that may enable the members to understand the meaning, scope, and implications of the item. In other words, an explanatory statements will be attached to anything which is a special business. Now, if the article of the says a statement need not be annexed, then for that private limited company, this statement need not be attached. So we need to spend a lot of time understanding the client when he walks into the office wanting to incorporate a company, sit with him, find out what he actually has in mind, and then draft out an MOA. If the client comes to you after incorporating the company online, where there are certain standard MOAs and MOAs available, and for a very, very stupid figure or a very paltry sum, a company is incorporated automatically by certain websites. There's nothing you can do other than amend it if this is what he has in mind. For example, if he is the main tech guy who incorporates the company, and he says, I don't believe in notices of 21 days. I want a notice of nothing more than 4 days. I can incorporate it. If I can't do it at the time it is incorporated, I can always amend it. Let us provide for it. Instead of trying to backdate something at a later stage, all those things can be done, provided we understand the client and then look at it carefully. Quorum. Quorum can specify 2 or more. A private limited company can say the quorum will be minimum 5 members. It cannot say 1, but anything more than 2, any number it can. So it need not be restricted to 2. Coming to chairman of meetings. A chairman of a meeting can be named the MOA. Or it can state that the current MD will be the chairman of the meeting. Or it can say the board will nominate the chairman for every general meeting. Any one of these things or all of them can be put into the MOA. And if they are there in the MOA, then to that extent again, this section 104 will not apply. Proxy. The private limited company AO can very clearly state that a proxy can only be a relative of a member. No outsider can be. In other words, although he is not a shareholder, he is a relative of the person of the shareholder, only he can be a proxy. The notice convening AGM only needs to bring it to the attention of the member that a proxy can be appointed. A form need not be attached with the company, and in fact, the company can define its own format and say that in this format only we will accept the proxy form. Again, all this should be there in the AOA. The time before which it should be deposited also can be stated in the AOA. So every one of these things in these 8 sections should be read. Should be considered threadbare when the client first initially walks into our office with the purpose of incorporated company. Understand the requirements. Tell him about the pitfalls in each one of these sections. Tell him about the compliance problems in each one of these sections. And based on what his feedback is, we need to put it to the AOA to ensure that we comply with the AOA to the omission of these 8 sections in the Companies Act. Voting rights. For example, if calls are pending, you can't vote. The private limited company says even if the calls are pending, one can vote. Again, all it needs is to be stated in the AOA. Voting by show of hands. The private limited company can specify that by vote of show of hands will not suffice, and all vote will only be by poll. Today, when you talk about a company being incorporated today by the next gen, or the Gen X, as they call it, youngsters have their own vision, have their own ideas. We need to sit with them, understand what they want. They don't believe in show of hands. They want everything to be documented. So, which means we need to have a poll. So, if that is what they want, let's put it that voting by show of hands will not apply. It will always be by poll. Demand for poll. When vote by poll has not been specified in the AOA, company can say that no voting can be demanded. So, both are possible. You can say show vote by hands is not sufficient, only by poll, or you can say poll can never be demanded, it will always be only by show of hands. Any one of the things is possible. All kinds of process, all things that you want with regard to the 8 sections need to be discussed with the client, understood with the nature and philosophy of the client, and then drafted in the AOA. But in my opinion, anything that you draft in the AOA, especially with regard to the 8 sections, must be well in line with the spirit of law. You cannot deviate from the spirit of law. It should be within the spirit of law, and then you can definitely put in whatever you want to put into your AOA. Exactly what we're talking. Private companies now have the option to provide their own regulations with respect to these 8 things, to the exclusion of the corresponding provisions of the Companies Act 2013. Filing of resolutions. Section 117(3)(g). Section 117(1) provides that a copy of every resolution in respect of matters specified in subsection 3 shall be filed with ROC within 30 days of passing of the resolution. Now, what does section 117(3) talk about? 117(3) says every special resolution, 2 resolutions which have been agreed to by all members, but which, if not so agreed, would not have been effective under the special resolution. 3, any board resolution relating to the appointment or reappointment or renewal of appointment or sanction of the terms and conditions and remuneration of a managing director. 4, resolutions agreed to by a class of members. 5, resolution for winding up. And 6, resolution passed in pursuance of section 179. All these resolutions within 30 days of passing the resolution. This is what section 117(1) says. 117(3) specifies resolutions passed in pursuance of section 3 of section 179. And the exemption notification says resolutions passed in pursuance of subsection 3 of section 179 will not apply to private. In other words, Only those resolutions passed in pursuant to section 179(3) need not be filed. All other things have still got to be filed. So we now need to look at what does section 179(3) of the Act says. 179(3) provides that a board shall exercise certain powers only by means of a resolution passed at a meeting of the board. And these are the ones: make calls to the shareholders, issue securities, borrow monies, invest the funds of the company, approve financial statements, approve merger or amalgamation. These 6 activities can be performed by the board only by passing a resolution at a meeting of the board. So if these things can be done only by a meeting of the board, then what is it that we are looking at? We will look at that now. Notification provides that section 117(3)(g) shall not apply to private, which means form number NGT 14 for resolution passed by the board in excess of the powers in the 179(3) need not be filed. So if these are resolutions passed by a private company, they need not be filed. That is all. It does not mean that these resolutions should not be passed. These resolutions have to be passed. They need not be filed. But please note that a private company will be required to file form MGT 14 in respect of other matters specified in section 117(3) of the Companies Act. Again, going back to that particular slide, 117(1), I told you that there are certain resolutions that will pass under section 117(1). What is that? Special resolution which have been agreed to by members, which but for such agreement would have need to be passed as a special resolution. Any board resolution with regard to the terms, appointment and terms and conditions of the managing director, any resolution agreed to by a class of shareholders, and a resolution winding up under the Insolvency Act, all those will have to be filed even by a private company. The private limited company need not file resolutions passed with regard to calls on shareholders, issuing of securities, borrowing of money, investing in funds of the company, approving financial statements, and approving merger and amalgamation. That need not be filed. I hope I am clear here. There is a bit of confusion because it refers to 2 sections, but this is what is contemplated by the exemption provided in the exemption notification. Moving on to the next chapter and the principal notification serial number 9, which deals with 141(3). This is very simple, but let us look. It only says a person who is in full-time employment elsewhere, or a person or a partner of a firm holding appointment as an auditor, if such person or partner is at the date of such appointment or reappointment holding appointment as auditor for more than 20 companies. In other words, an auditor cannot be appointed as auditor if he is already an auditor of more than 20 companies. The principal notification is inserted a clause after that, after the word 20 companies. It says, other than 1% company, dormant companies, small companies, and private companies having paid up share capital less than 100 crores. They are all, they can be concluded, they can be in addition to the 20 companies. So if to understand the section clearly, within the quantum or ambit of those 20 companies, what are the companies that will not fall into the ambit? 1% company, dormant companies, small companies, and not all private companies, but private companies having paid up share capital less than 100 crores. So if we are having 2 or 3 private companies which are having more than 100 crore rupees paid up capital, they will also have to become within the 20 companies. They cannot go out of. Very often, I heard in discussions with fellow chartered accountants, once it's a private company, then they are outside those 20 companies. No, the notification very clearly states other than 1% company, dormant companies, small companies, and private companies having paid up share capital less than 100 crores. So we need to be a little careful here. So pretty simple. Nothing complicated about it, but we need to be a little careful. We will also spend a little time looking at 139(2). 139(2) says, no listed company or a company belonging to such class or classes of companies as may be prescribed shall appoint or reappoint an individual as an auditor for more than one term of 5 consecutive years, and B, an audit firm as auditor for more than 2 terms of 5 consecutive years. Again, very simple. It says no listed company or a class of companies as may be defined or as may be prescribed shall appoint an individual for more than 5 years, a firm for more than 10 years. Essentially, we're talking about rotation of matter. This is where the rotation of matter comes in. So what are the classes of companies that have been prescribed? I think we need to have that in mind. Sometimes we miss it out thinking that a private limited company can never come under rotation. So we will need to look at what are the class of companies. Class of companies for the purpose of section 2 of section 139, the class of companies shall mean the following classes of companies excluding 1% company and small companies. All unlisted public companies having paid up share capital of rupees 10 crores or more will come under rotation. All private limited companies having paid up share capital of rupees 50 crores or more will come under rotation. So if you are doing the audit of a private limited company which has more than 50 crores, it will come under rotation. 3. All companies having paid up share capital of below the threshold limit mentioned in A and B, that is an unlisted public company with capital less than 10 crores, a private company with capital less than 50 crores, but having public borrowings from financial institutions or banks or public deposits of more than 50 crores of So if you have if you are the auditor of a private limited company which has borrowings of more than 50 crores, irrespective of share capital, it will come under rotation of auditors. I thought I should bring this to the attention of members, although this is slightly out of the syllabus of the topic that I'm dealing with. This is something which is not clearly understood because when the rotation of auditors came in and I listened to several things, mostly people said private limited companies are outside. When we were talking, we all understood it. Maybe the speaker did not say that, but most of us understood it as if saying that it will not apply to us because we are only doing audit of private limited companies. But there could be cases where a portion of it might apply to us also. So that is why I wanted to draw this to the attention of the discussion. Section 143.3 lists out what should be stated in the audit report, and it also talks about whether the auditor should report whether a company has adequate internal financial control with performance of financial report, ICFR. We all give a report. In addition to CARO, we also give this as a second annexure. However, the above clause shall not apply to a private company, which is a 1% company or a small company. If you look at it, the small company exemptions are very, very high. That's why I gave the definition of a small company. I think we need to be very clear about whether the company will qualify to be a small company. Not to be confused with small and medium company as defined in the accounting standard rules, but the small company as defined in the Companies Act. So it will not apply to one OPC, it will not apply to a small company, it will also not apply to for a private company that has a turnover of less than 50 crores or borrowings of less than 25 crores. Only if it is more than 50 crores or 25 crores, will it apply. Otherwise, it will not. Very straightforward exemption. My advice would be to check if ICFR applies. Please thoroughly check with the small company, and therefore ICFR will not apply. Do not give an ICFR report unless and until it is absolutely essential. We are putting ourselves in trouble by giving the ICFR. In the notes to accounts, there are several clauses which says non-confirmation, no confirmation is received in respect of debtors, no confirmation has been received in respect of creditors, confirmation of balance has not been reviewed with several parties, reconciliation pending in several cases, payments of, in CARO we state that the statutory dues have not been remitted regularly. Several things we say, and then we give a clean internal control financial reporting report. How can I have something in my audit report where I'm talking about confirmation not being received or reconciliation pending? Subject to that, at present, true and fair view, I can state. But when I say that these things have not been done, or I say that the statutory liabilities have not been paid within the due date or have not been paid properly, how can I give a clean internal controls over financial reporting report? In my opinion, there is a contradiction between the two. So in my case, I always look at, when in the case of private limited company, I always look at whether it is a small company. If it is a small company, I don't need to do ICFR. In fact, we have developed a template wherein when these figures, whatever the definition figures are put in, it tells us whether CARO is applicable, whether cash flow is applicable, whether internal financial controls are applicable, and whether corporate social responsibility. These things are applicable. So once that is available, based on that, our audit process and audit procedure to an extent changes. So look at these definitions a little carefully, especially the definition with regard to a small company. Private companies are free to include suitable provisions in the Articles of Association for eligibility of a person other than the retiring director to be appointed to the director of the company. Persons other than retiring directors may now stand for directorship in such companies without giving a written notice 14 days before the meeting and without deposit of 1 lakh rupees, which has been stated in the Act in section 160. A private limited company can have its own regulations as to who can stand for. The retiring auditor need not be appointed. For eligibility of person other than the retiring auditor to be appointed as a director. Anybody can actually go and do it, provided all the available in the AO. In fact, yesterday the speaker in the same, I think the second speaker of the day was talking about how the doctrine of legal expectation, where they thought that they will continue to be directors, but they are retired. That is the case of a public limited company. And I specifically remember the advocate speaker saying that the public limited company, and therefore, as per law, they had to retire. 1/3 of the directors will have to retire, and they could not have expected to be reappointed. In the case of private limited company, we can have any kind of things. We need to put that in. Let's again, to the point of being boring and repetitive, I would again and again only say, at the time of framing the MOA and the MOA, we need to spend a little more time than we normally spend with the promoters to understand their philosophy, their compliance with law before framing the MOA. This is an exemption, in my opinion, is merely for statistical purposes. Section 162 deals with the appointment of directors to be voted individually. That is, if there are 4 directors to be appointed, each director voting, each appointment, each resolution will be passed separately and be voted separately. The exemption given to private limited companies is if there are 4 directors, all 4 of those appointments will combine together and one voting is enough for all 4. Is this really an exemption? How does it matter if a single resolution or a joint resolution passes? In fact, if a meeting is actually conducted in a private company, it's a matter of 2 minutes more than the normal time. Every resolution will take 2 minutes, and therefore, if there are 4 directors to be appointed, it will take 8 minutes instead of 2 minutes. That is all the exemptions that are getting it. I'm actually reminded of my boss, under whom I did my apprenticeship. He would always say, Ramesh, in a private limited company, where is the question of a boardroom meeting? It is invariably a bedroom meeting where the husband and the wife, in those days, it was only a husband and wife. Even the sons and daughters were not part of the thing, who are members of this thing. So with that, in jocular jest, that being said, I really don't see what this exemption is about. It is more, I think, for statistical purposes that they've given an exemption where they say you can vote jointly instead of separately in terms of appointment of a director. Meeting of the board. Section 173(1) says there should be a minimum of 4 meetings every year, and not more than and it should be held in such a manner that not more than 120 days shall intervene between 2 consecutive meetings of the board. That is, there can't be a gap of more than 4 months. They have not said months; they have only said 120. For practical purposes, I'm saying 4 months between 2 consecutive meetings of the board. The exemption says for a 1-person company, a small company, and a government company, it is sufficient if 2 meetings are held, not 4. It is only 2 meetings is held. But there should not be a gap of more than 90 days. There should be a gap of not less than 90 days between 2 meetings. In other words, you can't hold a meeting on June 30th and one on July 1st and say 2 meetings are held in here. That is not possible. Or if you talk about a financial year instead of a calendar year, September 30th and 1st October, so that's not between 1 meeting and a second meeting, there must be a minimum gap of 90 days. Provided there's a minimum gap of 90 days and 2 meetings held, that is sufficient compliance with section 173(5) for a OPC, a small company, and a dormant company shall be deemed to have complied with these provisions. So again, you look at it, it is not applicable to all private companies, it is applicable only to a small company. Quorum for a meeting. The quorum for a meeting of the board of directors of the company shall be higher of 1/3 or 2. 174(3) says if at the time of, at any time, the number of interested directors are equal to 2/3 of the strength of the board of directors, the number of directors who are not interested directors and present at the meeting being not less than 2 shall be the quorum. So 174(3) says, if the number of interested directors are large and the number of non-interested directors being more than 2 and are present will count as quorum. In the case of a private limited company, it says they will be also form part of quorum. Interested directors also will form part of quorum. In other words, the related party transaction we saw about, the related party definition they spoke about in the definition has an effect also in section 174(3). Shall apply to a private company with the exception that the interested directors may also be counted towards quorum. So we don't have to look at separate quorum at all. Whereas in the case of other companies, you need to look at who are the interested directors, eliminate them, look at the non-interested directors, see if they are more than 2, and if they are more than 2, that will constitute quorum. Irrespective of the number, that will constitute quorum. If there are 10 members present, 8 of them are interested, then this 2 will be quorum for the resolutions, for the pass with regard to related parties. In the case of private limited companies, there is no need to look at it at all because the interested directors can also be part of the quorum. The principal notification states that section 180 shall not apply to a private limited company. Does this mean that the entire section will not be applicable? Section 180 talks about the board powers, and it says that the board shall exercise powers only with the consent of the company by a special resolution. What are those items? To sell, lease or dispose of undertaking, to invest otherwise in trust securities, the compensation for merger or amalgamation, to borrow money in excess of its paid-up share capital and free reserves, to give time for repayment of any debt due from a director. These are 4 items which the board cannot take an individual decision. They can only take it with the consent of the company by a special resolution. When the principal notification serial number 12 says that section 180 shall not apply, does it mean that these things they do not apply to a private limited company? That they can sell or lease the undertaking without consent of the shareholders, or they can borrow money in excess of its share capital and paid up share capital and free reserves without the consent of the company in general meeting? It's a little misleading. Let's look at the section again. 180 provides the board shall exercise these powers, shall exercise certain powers only with the consent of the company. The fact that 180 does not apply does not mean the board can delegate these powers to somebody else. The board still has to do it. The only exemption given is the board of the private company may exercise these powers without restrictions under 180, that is, without obtaining the consent of the majority of the company by a special resolution. Otherwise, it is not as if the entire 180 is not applicable. I am bringing this to note of the members only because in the discussion in another forum, some of the members said the exemption says 180 shall not be applicable, which means these activities that is listed there need not be done only by a board. It can be delegated. I am not in agreement with that interpretation. I am only, in my opinion, when it says 180 is not applicable, it only says consent of the company by special resolution is not applicable. How can the powers of selling, leasing, or disposing of undertaking be given to somebody other than the board of directors? Are they not the people who run the company, are in charge of day-to-day affairs of the company? Are they not the people who have to decide on investing in trust securities or borrowing money in excess of paid-up share capital of free reserves? If that is the case, if we agree that they are the people who are in charge of that, then that cannot be delegated to anybody else. The only exemption given is it need not be approved by the company in a special resolution. They don't need the consent of the company in a special resolution. That's what is stated in the next slide. Moving on to the principal notification serial number 13, which deals with 184(2), disclosure of interest by a director. Should a private limited company director also disclose his interest that he has in a body corporate or in a firm or an entity where such director or is a member or the case may be? Does he have to disclose his interest to the patient? Yes, But unlike the case of public limited company, he may participate in the meeting after disclosure of interest. So the exemption given is he can participate in the meeting, but he must disclose his interest. Because unless he discloses it, nobody will know what it is, and even the related party disclosure also will not be correct unless the director discloses interest. Therefore, he should disclose the interest as per the Act, but the exemption given by the principal notification is he can participate in the meeting after the disclosure of interest. Can a private company, can loan be given to a director? Section 185 talks about loan to directors. The first section, subsection of 185, says, no company shall directly or indirectly advance any loan, including any loan represented by a book debt, or give any guarantee or provide any security in connection with the loan taken by any director of a company or a company which is a holding company or any partner or relative of such director, B, any firm in which the director or relative is a partner, C, no, A and B only, sorry. So which means 185 prohibits loan to directors. What does the exemption notification say? Exemption notification is also applicable to 185. It says section 185 shall not apply to a private company if the following conditions are fulfilled. And what are those conditions? In whose capital, if it's a private limited company where in the share capital of the company, no other body corporate is invested. If the borrowings of such a company from banks or financial institutions less than twice the paid up share capital of 50 crores, which is lower. In other words, if the paid up capital, twice the paid up capital or 50 crores, whichever is lower, beyond that, the company should not have borrowed. And such a company has not defaulted in payment of such borrowing, subsisting at time of making the transaction 185, then a private limited company can give loans to directors, is what I understand from the exemption. But again, I as an auditor would always have in mind section 2, subsection 22, clause C of the Income Tax Act. Because will this lead to deemed dividend? Something which we need to look at. If there is no reserves in the company and it's only borrowings, then obviously 222E will not be attractive. But then the bank which has lent the money can take objection to it. You have borrowed from me and lent it to a director. The income tax department can also disallow interest portion because they will say you have borrowed from the company and lent it to a director for whom you are not charging interest. These are issues that are connected. The fact remains, and we need to be aware of, that a loan can be given to a director by a private limited company, provided these conditions are fulfilled. If in spite of the issues that are raised with regard to 222E, with regard to bank raising an objection, with regard to income tax assessment authorities disallowing a portion of the interest for borrowing from somebody and giving it to this thing, if the company still wants to give a loan to its directors, they can, provided these conditions are fulfilled. That's what it says. The principal notification serial number 16 states subsection 4 and 5 of section 196 shall not apply to a private company. So are we through with 185? I spoke about this just 2 minutes back. The same thing, which is there. Whatever I spoke is now on the slide. Let's move on to 196. The principal notification states that serial number 16 states that subsection 4 and 5 of section 196 shall not apply to a private company. 196 deals with appointment of managing director or whole-time director. So 197.4 mandates that a managing director or whole-time director shall be appointed, and the condition should be specified. Just 1 second, please. Section 187.4 mandates that a managing director or whole-time director shall be appointed, and the terms and conditions of such appointment and revision shall be approved by the board. The said appointment will be subject to an approval by resolution of the next annual meeting and by the central government in case it's appointment with variance to the continuing schedule 5. 196(5) clarifies that acts done by MD or a whole-time director before the appointment is not approved by the company shall not be deemed to be invalid. Now, what does the exemption notificate say? It says they are exempt from the provisions of 4 and 5 of section 196. In other words, 196 itself is applicable. The managing director, whole-time director shall be appointed by the board. That is no doubts about it. They cannot, nobody else can appoint MD or the WTE. Only the board can appoint them. The only exemption given is for 4 and 5. The terms and conditions of remuneration are not subject to any approval by the company in general meeting or by the central government. It can be done only by, and if they have done any acts, they can be deemed to be invalid or not deemed to be invalid. Now, coming to the condition for availing all the exemptions that we have been talking about in the last 1 hour or so, the principal notification paragraph 2A states that all these exemptions provided by this notification shall be applicable only to a private only if it has not defaulted in filing its financial statement under section 137 and the annual report under section 92 of the Companies Act. In other words, for the year ended 31st March 2021, if a private limited company has not filed its financial statements as yet and has also not filed its annual return under section 92 of the Act, it cannot enjoy the exemptions granted by these two notifications. Now we need to understand what do you mean by committed default in filing. In my opinion, the default will be from the due date on which it should have filed till the date it is filed. Once it is filed, the default vanishes, and from that day, the exemptions will again continue to apply to a private company. So to that extent, if there are cases where they have not filed for 2-3 years continuously, and you are looking at the audit of those companies, please see whether you can take, please ensure that you don't consider that company the private limited company. When you consider the private company, you don't consider the exemptions granted by these two notifications because they have defaulted, and as long as that default is not rectified, the exemptions granted by these two notifications that we are discussing will not be available to a private company. There is also an advisory given by them, paragraph 2, which says private companies, while complying with exceptions, modifications, and adaptations as specified in column 3, shall ensure that the interests of the members are protected. So, as I said earlier, you need to ensure that they are well within the ambit of law and in the spirit of law. Anything that is put in the AOA or MOA should be within the spirit of law and not outside. For example, you can't say the quorum can be 1. Those things are not possible. As long as it's within the spirit of law, you can have any things that you want in the MOA, especially for those management sections, the 8 sections which tell to the administration management, you can definitely have it. But you must also ensure that by enjoying exemption, the interests of the shareholders are not completely wavered. They should be protected, is what the advisory that says. More than the advisory, I actually want to draw the attention to this, because there are cases where even, for example, they have not, forget everything else, they have committed default. That means they should hold 4 meetings. They can't hold 2 meetings because they are no longer entitled to the 2-meeting concept of board meetings in a year. They need to hold 4 meetings as per the Act. At least that we need to ensure. Even if we are not worried about anything else, because those things are to be disclosed in every financial statement and the director's report. At least there, that we can't, we should ensure that that has been done and has been properly disclosed. So we also must keep this condition in mind, because this condition is actually a slightly dangerous condition. And we know, as auditors, we all know that quite a few private limited companies do not file on time. They do, they file a little later, paying the late fees of the charges levied by MCA. And therefore, they could have committed a default. The default could have been more than 6 months or 1 year, which means that the board meetings 2 is not enough, 4 should be done. These are things that will slip out of our mind. At the time of preparation of the financial statements or the audit of the financial, these might slip out of our mind. we need to educate the private limited companies and tell them that you don't enjoy the exemption of 2 meetings because you defaulted in filing your financial statements and the annual return, and therefore this financial year you should hold 4 meetings. These things are important because we could also be held responsible for it at a later date. A 1% company is one which is just has 1% of the member, minimum 1 director. Such OPC may either be a company limited by shares or by guarantee. Only a natural person who is an Indian citizen and resident in India was what it was before. Now it also says an NRA, in this latest budget they said even an NRA can form it, shall be eligible to incorporate a OPC. So this is what an OPC is. The OPC is one which is has only 1 member. Only a natural person can be a member. You can't have another company incorporating, being a shareholder and incorporating OPC. There must be an OPC or to be a nominee for the sole member of OPC also should be a natural person. You can't have anybody else because we all know in the case of OPC, there should be a nominee for that one shareholder. And if an OPC is constituted like this or incorporated like this, what are the benefits that it enjoys? There are only minimum 2 meetings in a calendar year sufficient for the board meeting. Rotation of order 132 will not be applicable. It need not file a cash flow statement. It need not file a internal financial control reporting. Signing of annual report can be signed by the company secretary or if there is no company secretary by 1 director of the company. In the case of OPC, it's only 1 person there. Board report, it is exempted from giving lots of details with regard to conservation of energy, technology adoption, foreign exchange, earnings, outgo, all that will not be there. Instead, Rule 8A will apply. So Rule 8, what does Rule 8A talk about? It talks about giving the web address if there is available, number of board meetings held, if any fraud has been detected, what are the nature of the fraud that has been detected, implicate explanation on auditor's qualification, the state of affairs of the company, the financial highlights, material changes, and so on and so forth. If you are doing the audit of an OPC, please look at Rule 8A of the company's account rules 2014 and then decide whether what needs to be put in there and ensure that is put in there in the report. Thank you so much for a very patient hearing. I hope you enjoyed my presentation as much as I enjoyed presenting it to you. I'm reminded of Winston Churchill when he wrote his exam in school, and he in a book wrote later, while I would have gladly displayed my knowledge, the teachers chose to display my ignorance by asking me questions that I was not aware of at all. I only request the members to not put me in a position like that if you're going to ask questions. But having said that, if there are any question that I'm unable to answer, I will certainly send a mail. My mail ID is given there. Please do write to me. I will certainly go through your queries and give you a reply to the best of my ability. Before concluding, with the permission of the chairman and the secretary, I would like to spend a few minutes more as a person who has been in practice for almost 4 decades and the kind of mistakes that we make in reporting in CARO. Let's take 1 or 2 small. First of all, CARO. Does it apply to all private limited companies? That is one thing which we need to look at. I have seen lots of private limited companies' financial statements where a CARO has been issued. And when I've asked them, why are you giving a CARO when it is only a small company? Invariably, all the members to whom I pose this question, fellow members to whom I pose this question, spoke to me that I have to issue a CARO report because I don't enjoy the exemptions that have been given to me by the corporate, by the company's account auditor's order 2020 or 2016, as the case may be. Let us look at who are the companies who are exempt from CARO. A banking company is exempt. That is 1. 2, an insurance company is exempt. 3, a company licensed to operate in Section 8 of the Companies Act is exempt. 4, a 1% company is exempt. And a small company as defined in Clause 85 of Section 2 of the Companies Act is exempt. In other words, if a company had a share capital less than 2 crores and a turnover less than 20 crores, it will be a small company and therefore it will be exempt. The 5th point in the exemptions, that is in the paragraph 1, The fifth point, a private company, not being a subsidiary or holding company of a public company, having a paid up capital and reserve and surplus not more than 1 crore. So if I have 1.5 crores share capital and let us say 19 crores turnover, I am a small company. But the fifth clause says the private company not being a subsidiary or holding company, public company, having a paid up capital and free reserves not more than 1 crore. Does it mean that because I have share capital of 1.5 crores, I am attracted by this fifth clause and therefore I will be subject to Karo? What happens to the fact that I am a small company and therefore exempt from Karo, which has been stated in 4 above? If you look at the guidance note issued by Institute of Chartered Accountants of India on Karo, they say once you are a small company, nothing else will apply to you. You don't have to go to the definition of other private limited companies. Private limited companies other than small company, which is given in clause 5 of para 1, subpara 2, clause 5 of Karo report. So I think we need to understand, the guidance note is very clear. I think we need to understand that if we don't have to give a report, let us not give that report. So let us first look at the applicability of Karo clearly and see whether it is applicable. Only if they are applicable should we go in. So if the share capital is less than 2 crores and the turnover less than 20 crores, take it from me, Karo will not apply. Even if the company has reserves of 5 crores. Or if it has borrowings of more than, borrowing exceeding 1 crore, it will still not apply. Because by definition of companies that small companies, we are a small company because less than 2 crores share capital, less than 20 crores turnover. And that is enough. Once the small company definition is satisfied, you don't have to go to the next condition at all. As who are exempt from it. Please look at that carefully. Second, there are several clauses in the Companies Act in Karo where I think we are making a mistake, knowingly or unwittingly. I think we need to look at those things. Please do not view this as ramblings of a speaker who loves to hear his own voice. It's not so. Somebody who has put in 4 decades of practice experience and who knows the perils of making mistakes in the report, who knows the perils of making mistakes in financial statements, who has seen very many cases where mistakes have been made and how those mistakes have landed chartered accountants in trouble. As long as the going is good, there's no issue. But once something goes wrong and the client or any of the stakeholders of the client, be it the banker, the income tax authority, the GST authority, make a complaint to the institute, it is the most dangerous thing for a chartered accountant. Believe me, I've seen enough people who have got this notice served. It's a mental trauma. The complaint could be of one thing, but when they look at the financial statements, the disciplinary committee might ask you questions in your financial statement or the reports that you have signed, which are not part of the complaint made by the person who was complainant, but you can still get put. For example, there's a question in Karo, which talks about whether the statutory dues have been deposited regularly. All of us blindly closing our eyes, the company has generally been regular. What do we understand with the term generally regular? Does it mean that they are regular? Are they regular some months and not regular some other months? Again, let us be guided by the guidance note of the Institute of Chartered Accountants of India. The Institute of Chartered Accountants of India has contemplated 4 situations for this question. In fact, the latest guidance note has 5 situations. One dealing specifically GST. And how many of us take cognizance of the fact that advance tax is also covered, income tax is also covered there, which means if the advance tax payable in June, September, and December has not been paid, and have been paid only at one installment in March 15th, is that not a violation which should be pointed out in Karo? Why are we not doing that? Why are we trying to defend a client and put ourselves in trouble? I understand that clients are the source of our bread and butter. But if I lose my certificate to practice, I won't have any chance to earn my bread and butter. I think we need to be clear about it. Second point that I already stated during the course of my presentation, there are several things that we put in the financial notes to financial statements, thinking that it safeguards us, but actually put us in trouble. If you say confirmation has not been received in record, how are you saying that they are recoverable? How are you saying that it is right? And then giving also a very clean internal financial control report. There is an internal audit, The internal auditors pointed out several errors, which have all been, been corrected in the month of February or March, haphazardly. We still give a clean IFCR report. Should we not in our IFCR report state that these were issues? They have since been rectified and have given a clean report. How many of us give a audit report for a sole proprietor who is not on a tax audit? Today, there are several cases in my own firm where, because of the rule of 5% of receipts and 5% payments not exceeding where the turnover up to 10 crores, will be outside even tax audit. But they want a financial statement to be signed for the purpose of giving to bank for the renewal process. How many of us give an audit report for that? Your auditing standards talks about an audit report even for a sole proprietor. Look at illustration 5 SA 700. It gives you the illustration, the illustrative audit report to use for a sole proprietor, for a non-corporate, not even sole proprietor. I would say non-corporate. How many of us do that? Anything that you attest must have a report. A certificate of net worth or certificate of turnover. We have examined the books of accounts of so and so and certified the following of the turnover for the 3 years. Is not sufficient. There is a guidance note issued to Untitled Chapter for special certificates, which has a format for it. Not that I am saying that all the certificates that we issue in our firm are all perfect. All I'm saying is it's a process of learning. When we know that what we've been doing all these years is not right, I think we need to make an effort to rectify it by reading the guidance note of the Untitled Chapter. Even if we don't read all the guidance note, whatever guidance note has been pointed out to us by various other members of the Institute or by speakers, can we not look at that at the time of issuing the certificate? Stock statements submitted to a bank, stamp is seal is levied there, examined and found correct or verified and signed. That's not the way. What have we verified? Are we attesting to everything in the stock statement? And today with Caro saying whether the stock statement submitted to the bank ties up with the books of accounts when we do the final audit, issues that we need to be concerned about, issues that we need to take a fresh look at. Although we've been doing it for the last several decades, are we today in an era where compliance are increasing and technology plays such a huge part to help the regulators to find out non-compliance? I think, in my humble opinion, we need to be more vigilant and more, more proactive to ensure that mistakes are not there in the financial statement that we attest. Thank you so much for a very patient hearing and also for the listening to the so-called advice that I gave you. Thank you so much.